Stocks to buy during the dip. Listen, the market is down, and the market is down big. At the start of the year, the S&P 500 was almost 5,000. Today, it's back down into the 4,200s, and I think as of last week, it's down in the 4,000. So, yeah, it's down huge. And the reasons are multifold. For example, concerns about inflation. The Federal Reserve's plans to fight it. The effect that it will have on the pocketbooks of the purchasing public, and the strength of the economy have all weighed on investors' minds. Is it time to panic? Should you sell, sell, sell? That would be a hard no, folks. You see, the savviest investors know that you buy when stocks are cheap. So you might argue that now is probably one of the best times to buy into the market, even if it goes lower. I'm going to talk about the best stocks for you to pick up during this lull in the market, including one in particular that might surprise you a little bit, after introductions, of course. I'm Derek West, host of Finance Squared, the best finance channel in all the land. And that's not my opinion, that's just science talking, folks. On this channel, we love talking about all things personal finance, including stocks, bonds, crypto, and real estate. If it involves lifting yourself up by your bootstraps and the tips and techniques on just exactly how to do that, we cover it here on this channel. So what are you waiting for? If that's your thing, subscribe to this channel with post notifications turned on so you don't miss the value stream. And be sure to lovingly, tenderly, gently smash that like button for the YouTube algorithm, particularly if you genuinely like the video. And if you feel I'm missing something or I'm off target with anything, like I'm just coming out of left field, be sure to let me know in the comments down below. Heck, if you think I'm doing an all right job giving you the skinny, let me know in the comments down below also. Any and all engagement is truly appreciated. And you wouldn't believe it if I told you how much all of it means to me and the team. So with that boilerplate out of the way, as I'm sure you know, the market has been down big the last couple of months. Over the last several years, we've gotten used to a never-ending bull market run that started in the late 2009s, actually. And not just stocks either. Real estate, commodities, crypto, and other assets just seem to keep rising in value, almost infinitely. Well, it would appear we are at the end of that run, or we're on the precipice of another major recession. The stock market is heading lower, and 401ks across the land, well, they're starting to feel the pain. That brings up the question, is it time to panic and go all in on municipal bonds, stuff like that? Well, on this channel, we always tell you that a well-diversified portfolio can never be a bad thing. That said, it's not time to sell your stocks yet. In fact, it's time to buy. Even if some of the stocks in this list go lower, just keep buying. Now that's not advice, that's for entertainment purposes only. There is a safe way to do this and a risky way to do this. I'll tell you all about the safe way coming up later in the video, so keep a sharp eye out for that. But remember, the best time to go shopping for great deals is when the merchandise is on sale, especially when that merchandise can power your net worth and grow with you when the market finally turns around. But shouldn't I wait till the market hits rock bottom before I buy? No, timing the market is a bad idea, typically. There's a great line from Wolf of Wall Street where Matthew McConaughey's character says that nobody knows what the market's going to do, whether you're Jimmy Buffett or Warren Buffett. And that's very true. Anyone that tells you that they know that's the case, well, they're probably a good guesser, a good liar, or both. So there really is no way to predict when you should start to buy again. Meaning, just sack up, get diamond hands, and start somewhere. That somewhere is here and now. If the stocks you buy go lower, then buy some more. Again, not advice, that's just for entertainment purposes only. And let me be clear, there is risks that any and all stocks could go to zero. If you're a strong believer in that eventuality, you should be shorting those stocks. Now that's a different topic for a different video. Be sure you're subscribed with post notifications turned on so you don't miss that one. But with that risk comes reward. And remember, if you're diversified enough, you can pull this off safely. Again, I'll tell you exactly how a little later in the video. For now, let's just take a look at the stocks that you're going to want to pick up. Again, not advice, for entertainment purposes only. Starting off with Amazon. Amazon is one of those corporate behemoths that just won't stop. Its fundamentals have not changed in the last 6 months. In fact, they've only gotten better. Its online shopping volume accounted for 41% of its digital sales in the US, according to eMarketer. That was up from 39% in 2020. The height of the pandemic, meaning not only is Amazon not retreating from pandemic-induced highs, it's advancing. And it's unlikely to lose its foothold anytime soon. If you have any interest in side gigs, then you're probably well aware of Amazon FBS as a legitimate pathway to success. Its brand name has become synonymous with online retail, and its expansive logistics network has consistently set the bar for fast shipping domestically and helping entrepreneurs set up their own side hustles and main hustles, as a matter of fact. But that isn't it though. Amazon has been successful expanding into very profitable industries. Its cloud computing unit, Amazon Web Services, posted revenue growth of 40% in the most recent quarter, capturing a 33% market share compared to its second closest competitor, Microsoft, at just 22%. Now, we mentioned how Amazon helps to enable entrepreneurs to make and scale their own side hustles and main hustles. One of the ways they do that is via the ads that they serve to customers. Its revenue from advertising services jumped 32% in the most recent quarter, and it captured nearly 12% of US digital ad spending in 2021. That put the company in third place, right behind Alphabet and Meta platforms. But the popularity of its e-commerce site makes it a great place for marketers to reach consumers, which again is about 41% of all digital retail sales. So they will soon be able to close the gap with other competitors. Even if they don't close that gap, remember that cloud computing and digital advertising are higher margin businesses to begin with. So as those businesses grow, their profitability will as well. So with Amazon at about 300 points off its all-time high, a purchase now makes plenty of sense. Speaking of making sense, let's look at one of the original online payment platforms, PayPal. PayPal is one of the main global providers of online payment services. PayPal stock's yearly performance dropped 64.17% and is down $86.03 per share on the year. The oversold stock is on a decelerating bottom line path, while net sales are expected to advance at a double-digit pace, up 15% to $29 billion in 2022. Net profits are forecasted to tumble 12.4% year over year to $3.63 billion. This punctual weakness is estimated to revert in 2023, since net income should rebound strongly, up 32% to $4.81 billion. Nevertheless, free cash flow growth will accelerate this year, appreciating 17.5% year over year to $6.38 billion. Whereas PayPal's net cash position will get a hefty boost of 489% to $8.54 billion. With that being said, the sharp deceleration of PayPal stock seems exaggerated, and an investor looking for value would seize this opportunity to enter this leading online payment specialist. Next up is a company that's been getting roasted the last couple of weeks on the stock market, Netflix. Netflix is the world's leading streaming entertainment service with 222 million paid memberships in over 190 countries, providing TV series, documentaries, feature films, mobile games across a wide variety of genres and languages. Now, Netflix stock, well, it got hammered. It lost more than 60% of its value at one point. This being on the heels of the announcement of the first decline in subscriber numbers in 10 years. Now, in the first quarter of 2022, their earnings per share came above the analyst consensus, posting a figure of $3.53 per share compared to estimates of $2.90 per share. Top line growth is expected to slow in 2022, growing at only 9.6% to $29.69 billion in 2021. However, the streaming company is still expected to deliver an encouraging profit margin of 15.2% in 2022, down 200 basis points on the year. In addition, Netflix free cash flow should advance robustly this year, posting a positive amount of $834 million. And that's opposed to a deficit of $159 million in 2021. After losing more than 60% of its valuation, the oversold stock, well, it should continue to trade at stretched multiples with a forward PE ratio of 19.7. Now, many analysts remain neutral on Netflix equity story, yet the average price target for Netflix stock share stands at $302 per share. So if someone were to gain entertaining and informative opinions on which stock to pick up, I think Netflix would be among them. So we just went over 3 oversold stocks that you should look into picking up if you're looking to buy the dip. Now remember, investing in individual stocks is just risky. That's an honest statement that no one can deny. The upside is there, meaning that you can get more profit from buying individual stocks than you can by investing in, let's say, index funds. But the truth is that there are many signs that the market will continue to head lower and lower. The Federal Reserve is looking to keep interest rate hikes going, and that's generally a good call as inflation is starting to flare out of control. But even if the Fed pulled back on interest rate hikes, the rate of inflation will affect the pocketbooks of consumers, causing them to tighten their belts and seize up on spending until their earning power is restored. This is going to negatively affect the bottom lines of many companies, causing them to pull back even further in terms of their valuations. Any way you slice it, investing in single stocks is risky. The best way, in my opinion, to get exposure to companies that will turn around after a big pullback is to consistently invest in broad-based index funds or ETFs that track major indices like the S&P 500. That way, you get an instantly diversified portfolio of stocks in companies that represent the best that this economy has to offer. When these stocks pull back, as long as they don't go to zero and rise again, and you manage not to sell your stake in an index or holdings of an ETF, you will profit handsomely. Even if they do go to zero or really hit a metric that pulls them out of the index or the ETF, they'll be replaced by other companies that will eventually rise further and further, evening out the loss of that stock. Now, there is a downside to this, in that you will not profit as much if you just held the individual stocks themselves. But the upside is that when a company's stock goes to zero, or whatever the metric is, it will automatically be dropped out of the index or ETF and replaced with another stock that is outperforming it, leaving you in the driver's seat to Wealth City. Lame metaphors aside, thanks for watching the video, guys. Don't forget to lovingly, tenderly, gently hit that like button for the YouTube algorithm. Subscribe and turn on post notifications. Drop a comment with some stocks you think are oversold and worth the time to pick up if you're living on the wild side and investing in individual companies. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'll catch you guys on the next one. Peace.